We've been watching the slow and steady rise in mortgage rates over the past few months, going from 3% at the end of 2021 to nearly 5% now. But what does a higher fixed mortgage rate mean for buyers, and what does it mean for the industry? A mortgage is an agreement between a borrower and a lender to buy or refinance a home or piece of real estate without having all the cash up front. The agreement often allows the lender to repossess the property if the borrower can't meet the mortgage terms, usually repaying the loan back plus interest in a set amount of time at regular intervals. But with fixed interest rates at 4.72%, their highest level in nearly 3 years, mortgage applications are dwindling.
I mean, considering that rates were at the 2% range, 2.5% for quite some time, for the last, I would say, 2 to 3 years. This year, however, it's a little bit different, right? With the Federal Reserve announcing that they will no longer purchase mortgage-backed securities, there's less liquidity in the marketplace, thus forcing the Federal Reserve to increase rates. Each 1% increase really means that it's about 11 to 12% less buying power. So that can take a little bit of an adverse effect on the psyche of buyers going into the marketplace today.
Total mortgage application volume fell 8.1% between the first and second weeks of March, according to the Mortgage Bankers Association's seasonally adjusted index. In other words, the hot market of last summer is no more. Higher interest rates on mortgages mean fewer bidding wars as well, as buyers wait to go in on homes. However, this may be subject to change as buyers anticipate rates rising even higher in the coming months.
Rates could go even higher, right? To even 5% range by the end of this year, maybe even 5.25%. I think buyers feel this sense of urgency. I think you're going to see a little bit of buyers sort of just folks that were on the fence really jumping into the marketplace.
In an interview with CNBC, Mortgage News Daily Chief Operating Officer Matthew Graham said that rates have a small chance of topping out before hitting 5% and a better chance of topping out before hitting 6%.
I think we've seen refinances sort of subside from last year with the increased rates.
While those who already own property can benefit from inflation, first-time homebuyers and investors are getting the short end of the stick. But lenders may be willing to sweeten the deal if rates keep rising.
One of the things that banks will continue to do as rates continue to rise, the margins start to compress, is that you may see banks really get a little bit more aggressive, right? Offer a little bit lower rates than what we're seeing in the marketplace to really just attract the borrowers to come in.
Have rising interest rates impacted you? Let us know in the comments.